Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Kelsey Berro of JPMorgan Asset Management has this to say. While the Fed may have been uncomfortable with the lack of government data, our conclusion from the information that is available is that the labour market continues to gradually weaken. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
Looking forward to having you through the jobs number in about 10 minutes' time. Let's talk about that jobs number. Is it stout? Does it make a difference to the debate on December 10th?
Well, if we look at it, it's been 76 days since the last jobs report. So if anything was in my fridge for 76 days, I would say, that's stale. Now, I think the most important thing that we've learned over the last 24 hours as it relates to the rates market is the new BLS schedule. So the fact that the Fed is not going to see the October or November jobs report until after the decision. And as a result, probabilities that the Fed is going to cut in December has come down. Now, I'm going to go into a little bit of what the Fed could do or will do versus should do. Now, what they will do, I think, is probably skip the meeting unless we get a really poor payrolls report today, because of the lack of data, because they are, quote, flying blind. But I don't really believe they're flying blind. You know, we've all been in planes. You go in a plane, you fly through clouds, you fly through fog, right? I'm not a pilot, but I'm pretty sure that when a pilot is flying a plane, they're not looking out the window, right? They have all of these technical radars and instruments that they're using. And honestly, I think that there is enough data out there for them to assess the labor market. And as I said in that opening, to view it as generally weakening over time. And that's even if this jobs report today comes out a little stronger. And if we were to do a whisper number, which I know we don't have for today's number, I would say it feels like the market is prepared for a modestly stronger number relative to what's on the echo screen for consensus.
So let's say it is moderately stronger and you don't get a 25 basis point rate cut next month. Does that mean that a 50 basis point rate cut in January is more likely?
I don't think so. I think that they feel moving gradually is appropriate, particularly when you're so close to neutral. So I think that if they do skip, we're still looking for 25 basis point rate cut in January. The market has been very efficient in terms of its repricing. So the past few days, you've seen the probability of December go down, but all of those rate cuts have really just been pushed into 2026, and the terminal rate for the Fed funds rate hasn't actually changed very much. So it's still around 3.1% approximately. So the market is really looking at this as a skip, not a pause, not a hold. And I think that the dot plot is also going to communicate that, meaning even if they don't cut in December, the 2026 dot is going to be below the current Fed funds rate.
I don't want to go back to this, but the idea of the expiration date of the food in your fridge, 76-day-old Wonder Bread or canned beans are very different than 76-day-old strawberries. And I just wonder how useful it potentially could be. Even if maybe you don't want to eat it, you could eat it and not get sick. I mean, is there something in this jobs data that's going to be relevant to how you see the trajectory for the Federal Reserve?
Yeah, absolutely. But what I would say is if you look at the NFP chart, you pull it up on the Bloomberg terminal, you type in GP, what you're going to see is a sawtooth pattern, right? The jobs numbers don't go in a straight line. You have a slightly hotter, you have a slightly weaker. You have to focus on the trend. And so that's what I'm going to be focused on in a few minutes' time. I'm going to be looking at what the 3 and 6 month moving averages are. I'm also going to be looking at how much of the jobs are cyclical versus acyclical. So most of the hiring that we've been seeing really in the last 6 to 12 months has been acyclical hiring. which is, I think, an indication of the fact that the labor market under the surface is a little bit more squishy. Why that matters for the Fed, it doesn't mean that they need to do emergency cuts, but it does mean that if they do continue to cut, it doesn't threaten their inflation mandate. And that's really, the question here is, if they continue to cut, does that threaten their ability to get back to 2% on inflation? And we would say no, that we're not really seeing evidence in the cyclical sides of the economy that wages are reaccelerating or the labor market is retightening.
From your view, how political has December gotten?
I'm not sure it's gotten particularly political. I think this is actually more about the fact that we are getting close to estimates of neutral. And so every single decision from here on out just gets harder. And to be fair, it is harder for them without some of the data that they had. So I wouldn't necessarily say it's more political. I just think that it's a tougher part of the economic cycle to try to determine what's going on.
Anne-Marie asked this question earlier on. I'd love your view, your opinion as a market participant, how you would react if they delayed the meeting until after the data dropped on December 16th. Not saying they're going to do that. Just as a market participant, how would you respond to that? Is that a good thing?
I would be very surprised. I think the market would be very surprised. I mean, that's
surprised
completely...
in a negative way, though.
I mean, I'm thinking through this as you're laying it out for me.
Sure, no worries.
And I guess the market would probably view that as the risk that the data that they're going to receive is weaker. And so, the Fed wants to pause so that they don't miss an opportunity to cut and then have to wait all the way till January. But it seems like a pretty high hurdle. I mean, they put out those dates for the schedule years in advance.
And the number dropped just moments ago. Payrolls came in at 119. That's an upside surprise. The estimate was 51K. That's a big upside surprise. But a lot of nuance elsewhere. A few other data points to point out. Negative revisions, unemployment climbing to 4.4% from 4.3%. The estimate was for that to stay at 4.3%. And some more timely data if you're looking at continuing claims. Continuing claims, the wrong kind of upside surprise. So if you're out of work in America at the moment, it's getting harder and harder to get back into the labour force. And that's what you see from that number almost repeatedly over the last several months. To get the market reaction, equity futures still near session highs on the S&P 500 and on the Nasdaq, supported by decent earnings from Nvidia. Bond yields off the back of this initially lower. They stay lower, down by 3 basis points on a 2-year at 3.55. Kelsey Berro of JPMorgan still with us. Kelsey, you've had 10 minutes to go over these numbers. What jumps out to you?
Yeah, so first of all, on the market reaction, clearly the market was somewhat prepared for a stronger number as it relates to September. But then what you had in the mix of it is a number of things that pointed to less strength than just the headline number alone. So to me, the things that stood out were the unemployment rate moving higher, and on an unrounded basis, that actually moved to 4.44. So not far away from 4.5. So, that's a meaningful thing to me. Continuing claims, also new cycle high. As you mentioned, it means it is harder to find a job. And then the third thing I would say is the concentration of job growth is still very high. So as I see it, 59,000 jobs created in healthcare and education, which is an acyclical area of the economy. And that's more than half of the job gains. Where you have the cyclical areas like manufacturing, professional business services, negative.
Are you saying there's a chance we might get a rate cut next month?
Yeah, this really is an interesting development. I mean, our base case has been that you will see a December rate cut. We tempered our expectations because of the announcement from the BLS. But, our general view is that the Fed is going to maintain an easing bias, and that's ultimately what's important. What's most important for the Fed is that the labor market is cooling, and as a result, it means they're able to cut rates without threatening their inflation objective. We see wages continue to moderate. We see inflation outside of tariffs as fairly benign. The bond market tends to agree with us as it relates to, you look at the inflation market itself, fairly benign pricing there. And so I think this is an interesting report that leaves December potentially still on the table, although it's going to remain a pretty close call.
If they decide not to cut in December, do you get more conviction to go into long duration bonds? The idea that this will cause the cracks to widen that we're seeing in the labor market.
So I think what we've experienced over the last few weeks are great examples of fixed income behaving the way that you would expect in periods when the market is trading risk off, serving as the ballast, serving as the diversifier within your portfolio, and that obviously comes down to having duration in your portfolio. So that is something that we have liked. We have a range for the 10-year of 3.75 to 4.25. When we're at the top of that range, you have the opportunity to increase that position. When we move down to the bottom of that range, we need to be thinking about two things. Are we still in a soft landing, or is the economy changing? If we're still in a soft landing, there's a limit to how much lower yields can go. If we are concerned about a harder landing, then there's even more space for rates to rally from here.
Kelsey, you brought up a great point. We're a hair away from that line in the sand, really, that Jay Powell's outlined, 4.5% unemployment rate. We were almost just there. Isn't that going to give the impetus on the Fed that they should be concerned with the labor market?
Quite possibly, but I do think that there are still two core groups that are going to not necessarily change their view as a result of this jobs report. I just don't think it's enough. So that the people who wanted to stay on hold probably aren't going to look at this immediately and say, I need to change my view, but they may be more likely to be less vocal in terms of their dissent. So it's kind of maybe a nuance there of they're less intensely against it because they are seeing that there are things happening on the other side. But, for those who are more concerned about inflation, that picture hasn't changed. We didn't get any new data on inflation yet, maybe a little bit on the wage side, but, that's limited. And, they can still say 4.5%, that was what was in our forecast. So not surprising us to the upside, and still a relatively low unemployment rate versus history.
Stay with us. More Bloomberg surveillance coming up after this. It's an upside surprise on the headline number, but plenty of nuance beyond that. Slightly wonky, but another number that's interesting is 80.2%. Here's what's coming from the BLS today. The September estimates from the Establishment Survey include both data collected on our normal schedule prior to the shutdown and also September data that businesses self-reported electronically during the shutdown. As a result, the Establishment Survey collection rate, 80.2%. For this initial release of September 25 data is higher than usual, so a higher quality report, if we can call it that.
Yeah, so where does this leave us? Does this leave us with a good report or a bad report? And you talk about how it's going to be a Rorschach test. That said, the fact that this is backward-looking, it's 76-day-old data, at the same time that you're seeing the ongoing continuing claims tick even higher, does seem to indicate there could be some kind of shift on the FOMC that leans toward where the market would like it to be.
Nela Richardson of ADP joins us now for more. Nela, welcome to the program. Some timely data, some not so timely data. How are things set up in the labour market from your vantage point?
So the rule in my house is 3 days and it's out. That's why we have a weekly index now. But I'm going to say that good news, bad news, it's always good news to see job gains. So I am cheering this September number. I'm cheering the fact that it seems a bit stronger in terms of the response rate. But I have to go back to August because that's where the ADP numbers and the BLS numbers are almost in sync. We saw 4,000 drop in August at ADP. And that's very similar to what the BLS saw as well. So going into September, there's strength there, but we note that in October, that strength may have been mollified. September is an easy month for seasonal adjustment. There's not as much hiring, but when you go into that October, November, December period of seasonal workers, it's going to be a little bit more challenging to offset the seasonal factors. And to note, the private sector was driving this jobs report, but it was the consumer-facing private sector that really carried the water in this jobs report. So goes the consumer when it comes to healthcare, when it comes to leisure and hospitality. So goes the labor market. The connection between the consumer and the labor market has never been stronger when you look at this report right now.
Nela, given that backdrop, does this give you the justification in your head for the Federal Reserve to cut rates next month? If you could just sort of go there and get a sense, is this a strong read or a weak read in your view?
The whole context of the Fed view of the labor market is that labor demand and labor supply are falling in lockstep. I think this report challenges that notion because what you see is that the unemployment rate ticked up, and on the worker side, you also saw a bit of a rise in the labor force participation rate. To me, that suggests that more people came into this market looking for work and didn't find it. And that's especially supported if you look at the continuing claims number that is continuing to edge up, telling us it's taking longer to get a job. This is a highly concentrated labor market. Only a few sectors are strongly producing jobs. It makes it challenging for workers with a general skill set to find employment. And I think that's what's going to challenge the Fed in December. It's not just a strong jobs market they have to look at the demand side. It's how the supply side is faring in a very concentrated labor market.
Does a Fed rate cut change this picture? I guess that is the key question that everyone keeps sort of coming back to.
Well, if this data is backward looking, a Fed policy move is very much forward looking, right? We won't immediately see the effect of a rate cut on Main Street. It will take several months for that apparatus to trickle in, especially when you look at the key way that Fed policy transitions into Main Street is through the borrowing markets, through the credit markets. Are consumers positioned right now for those big ticket purchases, a house, a car, a refrigerator, that really drives the labor market forward in terms of new hires? I think when you come to the holiday season, that's where the rubber meets the road. That's where the disconnect between the wealthy consumer and the low-end consumer really matters, because if that low-end consumer, that low-income consumer can't purchase in the same ways they do over the holidays generally, then we won't get the growth factor leading into the first quarter of the year. So a lot is going to be borne on the shoulders of that low-income consumer over the next 3 months, both when it comes to seasonal hiring and when it comes to seasonal spending.
Stay with us. More Bloomberg surveillance coming up after this. Looking ahead to the Federal Reserve meeting, Saira Malik, the CIO of Nuveen, writing December rate cut is a toss-up, but 3 rate cuts are expected over the next 12 months as the Fed leans incrementally dovish in the second half of 26. Saira joins us now for more. Saira, welcome. We've got to reflect on the data out just moments ago. Something for absolutely everyone. Does it change the debate for December 10th on the FOMC?
But we got 2 new data points today to help us determine whether we're going to get that rate cut in December. This is, first of all, economic data trickling in with this employment data, and also technology and consumer earnings. So first of all, on the payrolls number, for September, the number is stale. There's something for everybody in it. While we beat on payrolls, we have downward revisions and increasing unemployment rate. So I think that's mixed in general. We saw the odds of a rate cut move up from 30% to 40% on this number for December. Second, the good news is earnings, which has been the good news for the past few weeks. Nvidia earnings strong, Walmart showing the consumer is still shopping. That's good for earnings and good for large cap tech. The bubble that people were talking about in the markets was mostly in unprofitable tech and speculative tech. But I think from here, given Nvidia soothing the markets, tech will lead. We will get 3 rate cuts over the next 12 months, but December still a toss-up. We may approach close to 50% chances of a rate cut, but most of the Fed has been leaning hawkish recently. We heard that in the Fed minutes yesterday.
Sarah, you said that tech will lead, and this is an important point. Will tech lead because the Fed has been more reluctant to cut rates aggressively, or will it lead despite the fact that the Fed is more reluctant to cut rates?
Tech leads for 2 reasons. The first one is a moderately weakening economy. We are seeing that in the payroll data. And second is a slower pace of rate cuts. The moderate growth is good for tech because they have their own structural drivers. Artificial intelligence is alive and well. We can debate when will we see the ROI on all of the dollars spent on AI, but we will see AI continue to increase productivity for companies and eventually boost their revenues. That's the main structural driver for technology stocks. And I think they will continue to lead from here unless the economy shows significant signs of accelerating or the Fed dramatically decreases rates.
Talk about timely. Speaking of the labour market, this from Verizon just moments ago. Today, we will begin reducing our workforce by more than 13,000 employees across the organisation and significantly reduce our outsourced and other outside labour expenses. Saira, efficiency and operational efficiency, is that going to be a big theme for next year?
I think two themes will be for 2026. First of all, is that efficiency because of artificial intelligence. Every company seems to be talking about that. And also, because of inflation, we're hearing more and more about affordability and actually some decreases in tariffs in areas like beef and coffee. Is the economy still affordable for the consumer? Hearing a lot out of Walmart on that today. Those are two themes I think that are bubbling up and will continue through 2026 as we talk about how are we going to incorporate the value of artificial intelligence into our business models.
Saira, just before you go, top picks right now into the new year. What are they at the moment?
We love infrastructure. Infrastructure has tailwinds, more building in the United States, shift to artificial intelligence, and electrification of our economy. One stock in particular, NiSource, an Indiana-based utility, will be a nice play on this. It's one of the fastest growing utilities in the region. And we also like more conservative stocks that grow their dividends, dividend growers also. And NiSource is one that pays a 3% dividend yield.
Stay with us. More Bloomberg surveillance coming up after this. Angelo Zino of CFRA writing this: Nvidia's data center revenue demonstrating sequential acceleration. That validates our thesis on sustained hyperscaler spending. Angelo joins us now for more. Angelo, are these numbers, is it sufficient to restore the faith in this story once again?
So, John, thanks for having me. And I'd say, for today, yes. I mean, I think some of the concerns that are out there in the market continues to linger. And we all know what that is. I mean, I think probably the biggest issue out there is on the concern about financing and, getting the necessary financing from a number of these customers, not necessarily the hyperscalers, which we all know over the last 3 years have been absolute monster spenders. But as we look here kind of over the next 3 to 5 years, and we get this broadening out trade within the AI ecosystem, the likes of, the Oracles, the CoreWeaves of the world, OpenAIs of the world, they're going to be bigger contributors in these forecasts that you have out there for Nvidia, as well as the rest of the AI ecosystem. And the question is, clearly, is the financing going to be there as we kind of broaden out here?
Angelo, I'm so pleased you've gone there, because we've been drawing the distinction between the company and the way the company is perceived in the stock market as a stock, because they're two very different stories. And Angelo, when it came to the earnings of Nvidia, yes, they're fantastic. Yes, the guide is solid. But in many ways, some of that was inevitable, because we know what's happening elsewhere. Their biggest customers are spending a lot of money and promising to spend even more. Angelo, what I'm trying to understand this morning is whether what they've unveiled overnight, yesterday afternoon, is sufficient to reshift the story around the way people are treating the stock. Because over the last several months, for a long, long time, over the last several years, there was a view in this market that this story was built on the balance sheets of the hyperscalers. And this all made sense. It was strong. Now there's a worry that this is built on something else. Debt-fueled financing, maybe very skinny revenues developing over at OpenAI, and a loss of confidence. Angelo, and this is what I want to keep going back to, have they said anything in the last 24 hours that gets the market to reshift its thinking again about how it addresses this story in the stock market?
So not necessarily. But that being said, listen, I think when you kind of look out here over the next couple of years, I think the expectations out there, I think from most of the analyst community, is not one where, we're necessarily expecting north of $1 trillion in spend from OpenAI. At least that's not in the forecast, in the consensus estimates at this point in time. So I think that's a good thing. But when you kind of look at the broader investment community, they're kind of looking at, hey, listen, there are these promises that are being made or commitments being made, and there's no way they're going to meet these commitments. What I would tell you is that they don't necessarily need to see those full commitments being made in many respects. And there are going to be many different ways that Nvidia is going to continue to see higher revenue and a broadening out of their ecosystem. And I think it's also important to note that these hyperscalers will probably get much bigger in nature here over the next 5 to 6 years. I mean, we're looking for Microsoft to see their revenue double here over the next 6 years. We're looking for Alphabet to see, their revenue go up, 70 to 100%. So that cloud business for these hyperscalers are going to continue to get much bigger. We've seen the great momentum out of Q3 earnings season from these hyperscalers. So we do think those companies will continue to pave the way. And then that broadening out trade is going to be the question mark. But again, I think as long as it's incremental in nature and we see some sovereign AI opportunities like we just saw announced yesterday, I think that's going to help the overall narrative and get the stock higher here.
Angelo, that's a key point there, the sovereign purchases, and we'll get to China in just 1 second and how feasible that reopening could potentially be. I just wonder if you were satisfied by the response to having to finance some of your customers to continue buying your chips. There's a lot of fear around circular financing and why Nvidia feels the need to do that if there is so much external demand.
I think in some respects, Nvidia feels like it's an obligation of theirs. And, I wouldn't necessarily go as far as to say they're doing anything that isn't prudent in nature. I think this is one of those instances where it's extremely expensive to build a data center. You're looking at a gigawatt, data center at about $50 billion in nature. And Nvidia is essentially taking the lion's share of the profits for the industry. So in many respects, what they are doing is reinvesting those profits into the ecosystem to help build the AI ecosystem. In some respects, I don't necessarily think that's a bad use of funding. I also think it helps kind of improve the stickiness across, where they are within the ecosystem. So overall, I'm not necessarily concerned about some of these circular financing issues. However, and I'd actually expect to see more of this take place here over the next couple of years. So it is something that I think investors need to get somewhat comfortable with. But again, if it gets to a level where it gets just out of control, I think that's where it becomes problematic.
How much upside is there to Nvidia's shares if President Trump gets his way and the Congress is forced to drop some of the restrictions in terms of sales into places like China from Nvidia?
So I'd say China itself, we're looking potentially at least 20 to 30 billion dollars in annual, sales added to Nvidia's revenue. We think that would be conservative in nature. And, again, that would probably add, let's call it about 8 to 10% to their revenue trajectory. And you'd see a likewise impact in terms of the stock price move. Let's call it a 10 to 15% initial boost, we think, from that approval. So, we'll see whether or not there's going to be upside if there's approval, and then, to what extent those companies will spend on Nvidia's ecosystem. But, the good thing is it's at $0 at this point in time, and there's significant upside potential if they're able to get into China.
When you think about the upside potential, I know the Commerce Department yesterday came out with the green light to sell chips to the UAE and Saudi Arabia. Is it big enough to fill that gap that exists right now, that hole, when it comes to Beijing?
Probably not. And maybe over time it will be. And again, the good thing is it's $0 in revenue, or essentially zero, coming out of China. I would say this: China's got the second largest ecosystem of hyperscalers out there, right? You do want to sell into the Alibabas, Baidu's, Tencents of the world, and that would be an enormous positive if they can do that. I'd also say, when you kind of think about the developers that are out there, the developer community, it's something that Jensen has repeatedly said he wants to make sure he's got access to, and that they continue to build on Nvidia's ecosystem. That's not something you're going to get in any other area of the world. So it's extremely important, we think, from that perspective, that Nvidia gets back into China.
Given that, what you just said about how he talks to Chinese developers, how difficult is this line to walk for Jensen Huang when it comes between Washington and Beijing?
I think it's a difficult line. I think if there's anyone that can successfully do it, it's Jensen, and maybe you throw Tim Cook in there in some respects, and how he's handled kind of the China-U.S. relations. I think there aren't many CEOs that can do a good job with that. The great thing with Jensen is it seems like he's got the ears of both nations at this point in time, and that's a huge positive. He's got that power, and we think in many respects, we'll see how all this plays out. But it's taken longer than we've thought, to be honest with you. We thought at this point in time we probably would have seen Nvidia back into China. But again, these geopolitical uncertainties, you never know how long they're going to drag out.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.